Hello, I'm Finola Burke from Research as a Service, and welcome to our webinar on 3D Spatial Data Solutions Group, Pointerra, ASX ticker 3DP. Joining me is co-founder and CEO Ian Olson. Welcome, Ian.
Thanks, Finola. Great to be here.
Ian, in your own words, FY23 was not an acceptable financial result. What happened, and what is the team doing to address the impact on revenue and cash flows that program delays you've experienced with your larger US customers and prospects have presented?
Yeah, thanks, Finola. So anyone who's been following the company since we started operating in the US and more recently started to get some sizable runs on the board with the US utility sector through fiscal 21 and fiscal 22 would have seen the impact of the size of some of those programs on revenue and cash flows. And what we started to see late last year, and we reported on in the half year, and then have continued to report on through Q3 and Q4 of FY23. And obviously now into FY24 a little bit is the impact on the delay of those programs on our revenue and cash flow. So we're reliant, have been reliant in the past on a handful of very large customers. Those programs aren't sort of one-offs. We're involved across multiple business units with those utilities, whether it's vegetation management or engineering or resilience programs, what have you. So their requirement to capture network-wide data and have it analysed and interpreted on an annual or semi-annual or every 2-year basis is pretty much ongoing. So what we've seen, however, in the past 9 months to the back end of FY23, which had a significant impact on FY23, was delays in some of those programs. Added to the newer program with Amazon, which is obviously not a utility, where we're rolling out a digital twin solution across their US distribution centres, and that program started in Q3. In the March quarter, and then they went through a big restructure, and so that program got paused for a couple of quarters and is cranking up in Q2 of FY24 this the December quarter we're just in now. So that had the impact on revenue and cash flows that investors would have seen, and of course during the past 18 months we've grown the team. We've added BD, we've added product, and we've added engineering. So we grew our cost base, expecting revenue to continue to grow, and got caught on the wrong side of that. So that resulted in the result for FY23, which as you've said and in our own words is not acceptable. So what we've done is we've trimmed up costs a bit. We've got more certainty on when those programs are going to recommence. We've added new customers, and we've also grown the non-utility sector, so mining, oil and gas, and road and rail transport, to so that we're not so reliant on revenue and cash flows from that one sector.
Now that we've seen Q1 FY24, how do you see the balance of this financial year playing out in terms of revenue and cash flows, Ian?
Sure. So, Finola, we're still confident of delivering an underlying EBITDA for FY24 and a cash flow positive year. Obviously, the underlying EBITDA excludes the impact of non-cash items like share-based payments, which is the biggest below the line cost, or below the EBITDA line cost. But for us, it's very much a tale of H2. The big resilience programs, we announced one back at the end of July. And there are other utility customers and prospects in North America that are undergoing those big multi-year resilience programs. The Biden administration got through Congress late last year the Inflation Reduction Act and a bunch of other civil infrastructure investment programs that have created north of $1 trillion worth of capital that needs to be put into the ground across road, rail, power, and water. And that's a structural tailwind that we thought we'd see through the Trump administration. It didn't get support of Congress, the Inflation Reduction Act and the associated civil infrastructure stimulus programs have got up. They're being matched by many of the states. So the utilities, and a lot of them are, they're public companies, they're looking now at having federal and state money to add to their own capital sources, both debt and equity, on their own balance sheet, in order to undertake these significant multi-year programs where you're talking 5 to 10 years and billions of dollars per utility. So what we're hearing from our from the people that drive and fly to generate data that then gets stuck in our platform to interpret and provide condition assessment and risk weightings across road, rail, power, and water, those linear civil infrastructure assets, is that the next few years there will be more demand for the generation of that data than there is bandwidth in terms of capability, and and so they've had those aerial and mobile capture companies haven't had a great fiscal 24, so the calendar year that the Americans work on, and so they've suffered, as we have, with these sort of program pauses and the planning that's going on for these multi-year, multi-billion-dollar investment programs that are going to run for the next 5 to 10 years. So we're all kind of sitting waiting for the flood to start. And what we're being told is don't worry about this year. Worry about have you got enough capacity to deliver. The EPC contractors that are actually going to put the boots on the ground and the materials in the ground, whether it's road, rail, power, or water, they're also under resourced for the scale of investments that's coming. So it really is for us, calendar 24, calendar 25 and beyond in the North American market look like being quite significant and very different to what the past 2 to 3 years has looked like in that market for us.
Ian, that said, I guess there is an expectation that you will generate revenue from that business. Have you got any insights into when that revenue will start to flow from that CapEx program?
Yeah, so we see that flowing in H2 of FY24, and we see other utility prospects and customers adding to that stack, if you will. So as I said just a few minutes ago, the scale of demand for LiDAR and imagery, whether it's captured on a mobile device, on a vehicle, or from a plane or a helicopter or a drone, that the scale of what's coming is unprecedented in the last 20 odd years of aerial and mobile capture in the US. So, for us, it's a great place to be. That said, the last 12 months hasn't been a great place to be particularly from an investor perspective, as we've struggled with the delays of these programs. What it's forced us to do is to look inwards to make sure. We've always tried to be really focused and disciplined on cost management, and we've cautiously grown our team. And we grew it with the expectation that the programs would continue to unroll as we'd expected, and so we've had to make some changes there. But we've also focused on our other target sectors and bringing them along, and growing the spend from existing customers and new customers to lessen the impact that the utility sector has, the disproportionate impact it's had on historical revenue.
And the US team, you have grown that, or you have got recently raised capital to grow that team further. How is that all working out, and what can investors expect in terms of new US hires to further extend those multi-year opportunities?
Yeah, so I was in the US a couple of weeks back. Finola and our Chief Growth Officer over there, Joe Gerzak, who joined us back in June. It's his role in conjunction with the US leadership team to identify the senior BD folk that we can bring into the business that are really experienced at growing 7-figure ACV, ARR, enterprise sales accounts. And so we've got a couple of candidates in mind. They're not cheap, but what we've seen in recent time with a couple of the new additions, both here and in the US, is that they materially compress the sales cycle, and they're able to operate in the halls of the C-suite, EVP, SVP land, and unlock budget and shorten the time it takes to turn the deployments that we've had across business units in some of those utilities into enterprise-wide sales that are baked in, that are recurring, rather than program related, as we've seen in the past.
And if we look back a year or so, you were reporting ACV on a regular basis. We understand that you've decided to adopt ARR reporting as an alternate approach, but the company hasn't yet published this figure. Why is it taking so long to determine the ARR figure, and when can shareholders expect to see some clarity from this?
Sure. So the reporting ARR for monthly and quarterly and semi-annual customers is relatively straightforward. The ARR contribution from those US utilities is the harder piece. And what we're doing at the moment is working through an understanding of the programs that have been delayed. When are they coming back on track, or in FY24, and to what extent can we rely on them to be annual recurring in terms of not non-negotiable, but not program related, so they're baked in and that we can justifiably include in an ARR number. So we'd like to get that number out as quickly as we can, but at this point it looks like being something that's a New Year's story, so a Q3 story for us, rather than something that we'll be able to produce this side of Christmas.
We understand that you have customers paying as little as US $500 a month on in Pointerra's 3D's core platform subscriptions. And you previously profiled some very large enterprise customers spending in excess of $1 million US a year. What does a large enterprise customer look like, and how do you ensure that they renew each year, and what's the company's strategy to grow that spend over time?
Thanks, Finola. So we do have quite a spread of customers, as you've identified, survey and mapping customers and small engineering firms paying $500 to $1,000 a month, and then the very large asset owners, whether that's in road, rail, power, or water, and indeed emerging some of the oil and gas and mining customers starting to get up to that magic seven-figure number. The customer experience is at the fore. I think with SaaS, every day there's a customer logging into your platform and having some sort of experience with the platform and the team that sits behind it. And in our DNA is a focus on the customer experience. It's how we built the business. We've got a really rapid and agile approach to dealing with customer issues and challenges and the odd bug that the customers experience in using the platform. So that approach and that philosophy has actually allowed us to gain an enormous amount of trust with our customers. So we're able to how do you get to an enterprise customer who spends more than US $1 million per annum? Well, you land and expand. You find a business unit that's got a pressing problem, that's got budget, that might be a couple of $100,000 or $500,000 a year spend. You immerse yourself in that business unit and gain their trust, and then they become an internal champion for you, help you spread across business units. For the mining sector or oil and gas sector, you're being spread across sites. For a utility, whether that's road or rail or power and water, you're getting spread across business units by your internal champion. And so a large customer for us that's spending more than US $1 million per annum is a road, rail, power, water, mining, oil and gas asset owner and operator that have multiple sites, multiple business units, and in some cases are operating in multiple geographies. We've got a mining customer, a global tier 1 mining customer, where we're getting deployed across more than 40 sites globally, in more than a dozen different countries. And that's going to take a little while to roll out, but that customer looks like a nice, certainly well north of US $1 million per annum ARR customer. And as a tier 1 miner, the advocacy and the awareness of the use of our platform by their peers is a great tool for us to grow that sector itself.
You are targeting 6 market sectors. Given your sales and product engineering team is growing, but still far from large, are you concerned about focus? And what's the plan to grow capability across your emerging sectors?
Yeah, so I'm mindful of a comment I read a long time ago when we set this business up, and we looked at the market opportunities where you can be a mile wide and an inch deep, and that doesn't really engender that. If you're running your business that way, my sense is that and our sense has always been that you're going to have a very shallow platform or a very shallow operating offering that doesn't get into the nitty gritty of the challenges that are unique to and the nuances around the operating challenges for each sector. I mean, Pointerra Core at its heart solves more or less the same problems across sectors. But as you get into analytics and the analytics stack, and then into the answers, which is around business intelligence and risk, you're getting very sector specific. You're dealing with very sector specific problems and answering very sector specific questions. And our product and dev team have worked really closely with those customers in each of those sectors that have that are innovative, that do want to adopt a platform like ours to shrink workflow and simplify the complex. So we've basically taken the lead of our customers. So Pointerra Core is pretty much sold the same way into every sector, and then you engage with the innovative customers who want to press the envelope a bit and want to challenge the current status quo, and they it's those people that help you identify where to allocate the product and engineering resources. So it's very much customer led, Finola, and we've, if you look back at the past and looked at we've previously spoken in this forum about the revenue spread and the cash flow spread across sectors, and in the past couple of years it has been very much dominated by the North American market and the US and the utility sector in that market. So what we're seeing now is a bit more maturity across those other target sectors, particularly oil and gas and mining and road transport, and a geographic change as well, where we've got customers emerging in Western Europe and in South America, as well as adding to our existing stack of Asia Pacific and North America.
You've obviously, in each of those sectors, you've got very large total addressable markets. I mean, how do you choose which ones to go after? I mean, what do you need to see to warrant a focused product and BD strategy for each of them?
Yeah, the TAMs, which for a SaaS company is, I guess, for those unfamiliar with how we think about what a TAM is, it's really, if we had every customer in a sector in a geographic region using Pointerra core analytics and answers, what would that spend look like by customer, and what would that look like across the sector? And in North America, it's not difficult to build a bridge to 50 to 100 million US TAM in each of our target sectors. So if you step back from that for a minute, it's clearly significant, it's clearly large, and the opportunity is there in each of those sectors, but you can't be everywhere all the time. So again, you focus on the innovative operators in each sector, the people that are undertaking programs that are heavily reliant on the use of remote sensing data, so LiDAR and imagery, and need that digital twin platform to undertake the program they're involved in. And so for us, it's about identifying the real innovators in each sector, understanding that we've validated that sector because the TAM is so significant. And we previously talked about wanting to target a 50 million US ARR as our sort of stepping stone on the way to 100 million US ARR. And from our perspective, we could deliver that in a sector. In just the US utility sector alone would get us to both of those hurdles. What we've seen, though, in the past, certainly on that journey, is that there's some volatility in the programs, particularly in that energy utility sector. So I guess we're taking a more balanced approach to building some resilience and taking some volatility out of our forward-looking cash flows and revenues and that means that from the question a couple back about the BD folk, it won't just be utilities, it'll be mining, it'll be oil and gas, and it'll be road and rail as well as water, to add to the existing quite deep sector experience in the energy utility sector.
And Ian, there are a number of companies now offering to create digital twins for their clients. I mean, how does Pointerra's technology stay ahead of the competition And how confident are you that your technology is future-proofed against AI?
Yeah, I guess if we were talking a couple of years ago, Finola, or maybe 3 or 4 years ago, digital twins was a phrase that was more or less emerging. Certainly, we didn't start life as a digital twin business. We started life as a cloud platform to solve workflow problems around the use of point clouds, whether it's terrestrial laser scanning or aerial and mobile laser scanning. And what we've found is that the questions that our customers are trying to solve, the questions they're trying to answer and the problems they're trying to solve using remote sensing data, more often than not, involve them using three foundational data types. So the CAD, the design drawings or design plans that have been produced in a platform like AutoCAD, the imagery, so flat files that can also be turned into 3D imagery for through the photogrammetry process for visualization by the eyeballs, and then obviously the LiDAR piece, the laser scanning, the point cloud piece, which is our DNA. So the convergence of those platforms, or those three foundational data types, into the digital twin platform has there's not many platforms out there or desktop software applications that can scale and with an open API infrastructure be rapidly integrated into existing enterprise applications like Pointerra 3D can. So we've had a competitive advantage and retained that with our core IP around point clouds and the ability to visualize and analyze at scale and speed and accuracy. Having the ability to merge those three foundational data types into our version of the digital twin, and then being able to rapidly integrate that into existing and future enterprise applications for our customers has really put us out a bit in front of people who are talking about digital twins. And of course, one of the challenges with these newer phrases or terms is that the phrase and the term digital twin means different things to different people. We certainly are using AI. Our young software engineers who are coming to us straight out of uni they're already adversed in using even generative AI like ChatGPT to assist them in compiling code packs. But our R&D team's been out at the edge of what's possible with LiDAR since we started the business, and our use of AI. The use of AI is embedded in our daily software engineering programs and our R&D. What I would say though is that when people think about AI more traditionally or more generally, such as the ChatGPT, your generative AI, which is being able to query existing libraries of spoken word or of written word and imagery, the ability to do that in the world of LiDAR and 3D data is really not is not something that's possible unless you've got a hell of a lot of data and you've done a hell of a lot of training. And we've got one of the world's largest multi-customer repositories of 3D data, and we've been training our analytics, our programmatic code, human written analytics, and more recently our AI enabled analytics on that data for many years now. So again, competition's great. We don't see any nipping at our heels. We certainly don't see anyone bringing a digital twin platform the way we have to market, a cloud first, cloud born, cloud conceived, open API at either end, and the ability to scale to extremes at extreme speed with extreme scale. Almost on demand. I think we're really confident that we're still out there with a big moat and operating in a big wide blue ocean. But that said, we were talking a few minutes back about total addressable market. Investors have seen the results. FY22, FY23, and obviously those numbers don't speak to the opportunity. So our challenge is to bridge that gap between what we're able to generate and report and what that opportunity is. So that comes down to execution, and I think we've done a great job of executing in terms of product development and engineering. And what we need to do a better job of is executing at the BD and sales end, and hence those more senior hires. Who are familiar with the challenges of enterprise sales and can compress those sales cycles and bring forward some of those programs that we've been challenged with over the past 12 to 18 months.
And you touched on the Amazon contract a little earlier. So you've been they've been deploying Pointerra 3D for their autonomous warehouse solutions. Where do you see that rollout restarting? And do you think it'll happen in half two FY24? And how meaningful will it be to your numbers?
Sure. So I think we made an announcement back in January of the contract award and the initial scope of a couple of hundred sites. Finola, the opportunity is to scale to 700, and which makes it a really meaningful seven-figure ARR subscription. The Amazon itself, if anyone's been following that story, they've been through about a 6-month restructure process where they've been ripping some cost out of their business, and the people we've been working with, the team we've been working with, have been caught up in that process. So Q3 FY23. We did a little bit of work for them. It certainly wasn't a massive amount, and it's site by site. Q4 and in Q1 FY24 we're on pause, and I think in the most recent quarterly we announced that planning was starting this quarter for rollout for the recommencement of that program. And it's our hope that we extend what we've done to a handful of sites over many hundred sites in North America, and then really use that experience in facilities management and the use of Pointerra and our digital twin platform for facilities management to really open up another sector for us outside of Amazon into other logistics and facilities operators around the world. So it's not a very sophisticated use of the Pointerra platform, but it is a very, very the scale of the opportunity is enormous just because of how many discrete sites there are.
And you've preferred a direct sales model over the past few years, but have recently announced some new partnerships with Esri, AWS, Emerson and Carbonex. Why the change in focus, and what should investors expect from these partnerships?
Sure. So, Fiona, when we started out back in 2015-16 and sort of got our minimum viable product, and we got out there trying to, with a very limited team, there was only half a dozen of us, and we didn't really have the bandwidth for the direct sales approach. We worked really hard with some of the industry players around creating channel partner opportunities. What we learned was that we're a little bit early, they're a little bit early. And there was not a really thorough understanding. The word digital twin didn't exist. Point clouds were still being, the domain of point cloud processing and analysis was still very much desktop driven, and those partners that we were working with at the time were still very much focused on their desktop applications. So fast forward 5 or 6 years, almost every business has migrated to the cloud in terms of storage and processing capability, and so with Esri, who's the world's largest GIS and original GIS software solution, becoming a partner of theirs and readily integrating our platform into. I mean, most of our enterprise customers have some sort of Esri deployment, and a lot of them are using Pointerra to generate output to then feed into their Esri account to spread that across the enterprise. So getting partner certification with them, more recently going through a fairly rigorous process with AWS to be on their marketplace. So existing AWS customers who can now buy Pointerra's solution by their AWS account. And again, what does that help us do? Those AWS has got a global sales team. They're out there trying to sell more than just storage and processing, which is the core of their business. So they're looking to bring partner solutions to their customers. So again, that was a natural extension to us of being an AWS partner, a certified partner, and then taking advantage of their sales force. The Emerson and Carbonex partnerships are more about. Those organisations aren't nearly as large as Esri and AWS, and the relationship's quite different. But the theme is really important. We're finding a lot of our asset owner customers, so road, rail, power, water, mining, oil and gas, experimenting with the deployment of drones, autonomous drones, human operated drones, and robotic capture devices into places where you don't really want to send a person, and they're getting, they're really innovative hardware applications and solutions, and they generate fantastic data, but almost to a customer. And these are our customers and the customers of people like Emerson and Carbonics. The response has been, well, this hardware solution is fantastic at generating all this data, but we can't operationalize the use of your platform unless we can very rapidly turn that data around and interpret it and give us the answer that we're looking for. We sent the drone or the robotic device in there for a reason, but we need that answer really quickly. Otherwise, we can't operationalize the use of it. So this theme with these challenger hardware solutions that are emerging all around the world, and obviously Emerson and Carbonics are two great Australian stories, is helping them sell more hardware by helping their customers, who are also our customers, operationalize the use of those hardware devices. So they're very different partnerships, but for us, it makes perfect sense there. But importantly, and we started out this interview talking about Pointerra being a customer-led business. It's our customers telling us, hey, you guys need to tell Emerson, you need to tell Carbonics that they need to integrate their platform with yours, because we're using you guys, and if they can integrate with you, that's going to allow us to operationalize the use of this solution. And then that means that both Pointerra and those partner companies can scale the spend from those customers. So very, very symbiotic, and we expect to see more of those hardware vendor relationships develop in different sectors and in different geographic segments.
Ian, final question. Looking beyond 2024, what can investors expect from Pointerra, and where do you see growth coming from?
Sure. So beyond FY24, so I guess we've painted a little bit of a picture about what the rest of FY24 looks like, which is really disciplined focus on cost management whilst delivering underlying EBITDA and a cash flow positive year. As we've discussed, very much a tale of H2, given that some of the challenges we experienced in FY23 have spilled over into the first quarter of FY24, but are already showing signs of unsticking. Example, some of the energy utility resilience programs and the Amazon warehouse program we talked about a little while back. But into FY25 and beyond, for us, I think we talked a few minutes back at the start of the interview about this structural tailwind. So investors who are looking at our financial performance over the last year or so can be rightly disappointed. What's harder to see for them is the improvements we've made in product across different sectors. So the scalability, the reliability, and the depth of sector-specific solutions that we've built through the Pointerra analytics and answers stacks. That investment again hasn't translated yet into revenues and cash flows into the business. But with the structural tailwind in North America of more than $1 trillion worth of capital that needs to get into the ground, ultimately it's boots on the ground and materials which is the big part of the spend. But in order to undertake that spend, all those linear infrastructure asset owners are going to have to figure out where to spend it, and the only way to do that cost effectively and in a timely manner is to purchase a very large amount of remote sensing data, so satellite, aerial lidar, aerial imagery, mobile lidar, mobile imagery. And so for us, what can investors expect from the company beyond FY24? I think taking advantage of that structural tailwind in North America, so continuing to invest in the US sales team, but also having experienced the reliance on that US market over the past 12 months, which has been challenging for us, making sure that we're balancing our investment in the other sectors, which a lot of them are emerging out of our domestic market, which is in particular mining, oil and gas. So I think if you look forward to FY25 and 26, what we could say is we've demonstrated financial maturity. We've started to identify what operational leverage looks like, and by operational leverage I mean when does our operating cost base start to flatten out relative to a continual growth in revenue. and underlying ARR, and then I guess a more balanced, homogenous revenue contribution by the different sectors. So still very much being led by the US energy utility space, but with equal contributions in North America from road, rail, and power, and then globally from the mining, oil and gas sectors. So that, for us, the story, if people were listening to interviews from a couple of years ago, I'd like to think that the story's the same. It's what we've seen is that the timing for us has been out of our hands. We've built a cost base expecting a high level of continued program expenditure. We've seen some of those programs delayed. They're not the programs we talk about, Finola. They're not optional. So these companies, they have to spend many millions of dollars per company per annum acquiring remote sensing data to understand the condition of their network, and then figure out where to spend their sustaining capex and their repairs and maintenance opex. So those programs aren't negotiable. However, they do get deferred, and we saw that with the oil and gas sector pre-COVID and during COVID, when oil, when the bottom fell out of oil, a lot of really basic corrosion-related repairs and maintenance spend and programs globally in oil and gas facilities has been deferred, and they're playing catch up now, and which is why we've got a really good focus on the oil and gas sector. They are playing catch up. The oil price outlook is facilitating that. Whether it's in the construction phase or the operations phase, or even the rebuild dry dock phase, where FPSOs move into places like Singapore and get significant refurbishments, or even end of life. The use of a platform like ours is becoming central to efficiently undertaking those significant activities, and where a day out of production means tens of millions of dollars in lost revenue. So the ability of a platform like ours to smooth and simplify and optimize the way those oil and gas companies plan and execute those capital works programs and those R&M programs, has an outsized impact. The use of a platform like ours has a real outsized impact compared to the to what we require as subscription income. So what does that mean? It means a great ROI for the customer, and we've had some early success with through our more recent hire here, our Chief Growth Officer in this region, who's very much oil and gas focused. So beyond FY24, operational leverage, more maturity, and across the sectors from different sector contributions, not being as reliant as we have been in the past, purely on the US energy utility sector.
Well, thank you, Ian, for the in-depth discussion today, and for your frankness on the issues that Pointerra has faced and the opportunities that business has in front of it. If viewers have further questions, they can be emailed to investor.relations@pointerra.com. That's all we have time for. Thank you for joining.
Thanks, Finola.